These are three assets that survived the Great Depression: the 1970s stagflation, the 2008 financial crisis, and COVID-19, though none of them protected capital in every scenario. Gold, silver, and US Treasury bonds each preserved wealth through different crisis types, and understanding when each one succeeded and when it failed tells you something about how markets actually work during chaos. What survived really means here isn't about getting rich during every crisis, but about positions that didn't lose everything when the world looked like it was ending. The pattern across these four massive crashes reveals an uncomfortable truth, which is that there's no perfect crisis hedge, and each asset has its kryptonite. Gold entered the Great Depression at $20.67 per ounce, under the gold standard, and when markets crashed in 1929, that price stayed fixed, while stocks collapsed 89%. But here's where things get interesting. April 5th, 1933 brought Executive Order 6102 from President Roosevelt, requiring Americans to surrender their gold coins and bullion to Federal Reserve banks at that fixed price of $20.67 per ounce. The penalties for keeping your gold added up to $10,000, approximately $243,000 in today's money, plus 10 years in prison. Milton Friedman's research found that roughly 50% of citizens ignored the order, with about $287 million in gold coins never making it to the Federal Reserve. And that's when the government pulled its trick. January 30th, 1934 saw the Gold Reserve Act signed into law, and gold got revalued overnight to $35 per ounce. That 69% gain went straight to the Treasury, not to the people who'd been forced to hand over their gold at the old price, and the government walked away with roughly $3 billion from this devaluation. The loophole turned out to be gold mining stocks, which remained legal to own. Homestake mining climbed 519% from $80 per share in October 1929 to $495 per share in December 1935, and that's excluding dividends that grew from $7 to $56 per share, pushing total returns towards 700 to 800%. When the Dow hit its absolute bottom in July 1932, down 89% from its peak, Homestake was actually up 49%. The 1,970 seconds tell a different story. Nixon closed the gold window on August 15, 1971, ending dollar-to-gold convertibility when the official price still sat at $35 per ounce, and what followed became the greatest gold bull market in modern history. The climb was steady at first, reaching $97 in 1973, $154 in 1974, and $306 in 1979, but then it exploded. January 21st, 1980 brought gold to $850 per ounce, which represents a 2,329% gain from where it started in 1971. What drove it was a perfect storm. The first oil shock hit in 1973 and 1974. Then the second oil shock arrived after the Iranian Revolution in 1979, while inflation topped 14% and real interest rates went negative. The Soviet invasion of Afghanistan in December 1979 and the Iran hostage crisis added fuel to the fire, and Paul Volcker's aggressive monetary tightening starting in October 1979 eventually broke inflation, which also ended the gold bull market for 2 decades. The 2008 crisis looked different from the start. Gold came in around $650 to $700 per ounce in late 2007, benefited from safe haven flows, and crossed $1,011 for the first time on March 17, 2008 during the Bear Stearns bailout week. The Lehman Brothers collapse changed everything. Between March and October 2008, gold dropped approximately 25 to 33%, bottoming near $692.50 as institutions liquidated everything for dollar cash during the acute liquidity crisis. This decline proved temporary, with gold recovering through 2009 and 2010 to peak at $1,917.90 in August 2011. The full calendar year, 2008, still gave gold a 6% gain, while the S&P 500 collapsed 38.5%. COVID-19 inches 2020 followed the same playbook. Gold sat around $1,500 to $1,600 per ounce entering the year. fell roughly 9% during the March panic as cash became king, but then recovered to reach $2,063 by August 7, 2020, marking its first ever close above 2,000 and setting a new all-time high. Full-year gains for 2020 totaled approximately 25%. December 2025 finds gold trading near $4,200 to $4,300 per ounce after setting an all-time high of $4,381 on October 20th, 2025. The rally from 2024 to 2025, roughly 64%, came from central bank purchases, particularly from China, rate cut expectations, and geopolitical tensions. But here's what the gold bugs don't tell you. From 1,980 to 2,000, gold generated no returns whatsoever. The price fell from $850 to $252, a 70% decline. And in inflation-adjusted terms, the 1,980 peak wasn't recovered until 2011. That 31-year drought destroys the narrative of gold as a perfect store of value. The depression hit silver harder than gold. Prices crashed from approximately 53 cents per ounce in 1929 to 25 cents by late 1932, a 53% loss that left silver holders devastated. The Silver Purchase Act of 1934, signed June 19th, established a government purchase price of 50.01 cents per ounce, while Executive Order 6814 on August 9th, 1934 required delivery of silver to the government within 90 days. Silver wasn't technically confiscated the way gold was, but private holdings got capped at 500 troy ounces, which meant about 113 million ounces were delivered to the Treasury. By 1939, silver was pegged at 71 cents per ounce, providing modest stability but nothing like the government-engineered gains that gold saw. The 1970 seconds brought one of the wildest stories in financial history. Nelson Bunker Hunt and William Herbert Hunt, heirs to the H.L. Hunt oil fortune, started accumulating silver in the early 1970 seconds when it traded below $2 per ounce, and their father's death in 1974 left them a $5 billion inheritance that they used to accelerate purchases dramatically. Their accumulation eventually reached approximately 200 million ounces, roughly one-third of the world's privately owned supply, and they flew physical silver to Switzerland in specialized aircraft guarded by armed Texas ranch hands. Tiffany's got fed up and took out a full-page New York Times advertisement condemning their hoarding as unconscionable, but the Hunts kept buying. January 1st, 1979 saw silver at $6.08, and by January 18th, 1980, it had reached $49.45. That 713% gain in 12 months destroyed the previous decade's performance record, with the total climb from $1.55 in 1971 to the peak representing approximately 3,090%. The collapse came just as fast. COMEX enacted Silver Rule 7 on January 7th, 1980, restricting margin purchases, and then came Silver Thursday on March 27th, 1980, when prices crashed from $21.62 to $10.80 in a single day, a 50% plunge that broke the Hunts. Their margin calls couldn't be met, and $4.5 billion in paper gains evaporated into $1.7 billion in debt. A consortium of US banks provided a $1.1 billion bailout. But by 1982, silver had collapsed to $4.90 per ounce, a 90% decline from the peak, and both brothers eventually filed for bankruptcy. Silver's industrial demand, approximately 60% of total consumption, made it more vulnerable than gold in 2008. Prices peaked around $21 per ounce in February 2008, before crashing to $9.09 in October, a brutal 57% decline compared to gold's roughly 25 to 33% drawdown, and the gold to silver ratio exploded to 88 to 1. What followed was a spectacular recovery. Silver climbed relentlessly through 2009 and 2010, ultimately reaching $48.70 on April 28, 2011, nearly matching the Hunt brothers' 1,980 high, and from the October 2008 bottom, that 436% gain roughly tripled gold's performance during the same recovery period. COVID-19 hit silver even harder than 2008. The price fell from approximately $18 per ounce to $12.97 on March 16, 2020, a 40% decline that marked the lowest price since 2009, and the gold-to-silver ratio spiked to an all-time record of 125-to-1. Recovery came rapidly though, with silver peaking at $28.33 on August 18, 2020, more than doubling from the March lows and outperforming gold's recovery by nearly 3 times. Late January 2021 brought a strange footnote when posts appeared on Reddit's Wall Street Bets targeting silver as the biggest short squeeze in the world, following the GameStop squeeze. Silver briefly approached $30 per ounce on February 1, 2021, and physical coin premiums exceeded 100% over spot prices, but the squeeze failed because silver's $1.4 trillion market proved too large to corner. Many Wall Street Bets users actively denied organizing the attempt. December 11, 2025 saw silver reach a new all-time high of $64.31, finally surpassing the 1,980 Hunt Brothers peak after 45 years, and year-to-date 2025 gains exceed 119%. The Depression gave Treasury bonds their finest hour in history. Stocks collapsed 89% and corporate defaults spread like wildfire, which sent investors fleeing to the only truly default-free asset available. Treasury bonds returned approximately 6.04% annually during the 1,930 seconds, while corporate bond yields fell from 4.59% in September 1929 to 2.94% by June 1938. Two Wall Street figures named Alfred Lee Loomis and Landon Thorne famously shifted to long-term treasuries and cash by early 1929, which preserved their fortunes while their peers got ruined. Treasuries provided both capital preservation and meaningful positive returns, while equities were getting decimated. The 1,970 seconds revealed Treasury bonds' kryptonite, sustained high inflation. 10-year Treasury yields rose from approximately 5% in 1967 to 15.68% in October 1981, the historic peak, and bond investors suffered approximately negative 3% annually in real terms from 1,973 to 1,982, with long-term bonds losing roughly 33% of purchasing power over the 14-year period. August 1979 brought Paul Volcker to the Fed chairman role, and he announced dramatic anti-inflation measures in a rare Saturday press conference on October 6, 1979. The federal funds rate ultimately reached 20.06% in January 1981, an all-time high that eventually broke inflation, but bondholders suffered severe losses during the entire tightening cycle. Treasury bonds delivered their second-best crisis performance in 2008. The 10-year yield fell from approximately 4 to 4.5% in 2007 to 3.25% immediately after Lehman's September 15, 2008 bankruptcy, while 3-month T-bill yields fell to nearly 0%, the lowest since World War II. The iShares 20-plus year Treasury ETF gained 33.92% in 2008, while the S&P 500 lost 38.5%, which created a 72-plus percentage point outperformance that stands as one of the most dramatic flight to quality episodes ever recorded. COVID-19 started with the classic crisis playbook. The 10-year Treasury yield plunged from approximately 1.51 to 1.92% in February 2020 to an all-time low of 0.318% in overnight trading on March 9, 2020, and the 30-year yield hit a record 0.702%, breaking below 1% for the first time in history. And that's when something unusual happened. Treasury yields spiked 64 to 65 basis points from March 9th to 18th, even as stocks kept falling, the opposite of normal crisis behavior, because leveraged fund deleveraging and a dash for cash created severe illiquidity. The Federal Reserve intervened massively by purchasing approximately $700 billion to $1 trillion in treasuries during the first quarter of 2020 alone, And the 20-plus-year Treasury ETF still finished 2020 with 18.15% returns. Here's the pattern that emerges. No single asset protected capital through all four crises. The inflationary 1,970 seconds gave gold and silver massive gains, while Treasury bonds lost 33% of purchasing power, and the deflationary depression and 2008 crisis saw Treasury bonds excel, while gold got confiscated or temporarily crashed. Silver amplified everything, the gains and the losses, with roughly 2 to 3 times gold's volatility in every direction. Gold works as insurance against monetary system failures and currency debasement, excelling when investors lose faith in paper currencies, but it fails during periods of strong economic growth with positive real rates, delivering negative returns from 1,980 to 2,000 while stocks surged higher and higher. Silver amplifies precious metals exposure, but that industrial demand creates economic sensitivity that gold doesn't have. The pattern repeats where silver crashes during initial crisis phases, when industrial demand collapses, only outperforming later when monetary demand takes over. Treasury bonds represent the ultimate deflation hedge and flight to quality asset, excelling during growth shocks, banking crises, and deflationary spirals, but the 1,970 seconds demonstrated how they fail catastrophically during sustained inflation. A portfolio containing all three would have experienced smaller drawdowns across different crisis types than any individual holding, though optimal allocations would have varied dramatically depending on whether the crisis was deflationary, inflationary, or involved acute liquidity stress. The uncomfortable reality is that every crisis is different. What saved you in 1929 could ruin you in 1979, and what worked in 2008 might fail in 2020. The assets that survived every crisis since 1929 did so by taking turns, with each one stepping up when its strength matched the market's fear. Understanding which asset protects against which crisis type matters far more than believing any single position can save you from everything.